What if one tenant moving out could cost you over $5,000 even before renovation starts? And here's the thing, this isn't just theory. We've tracked turnover costs across hundreds of rental units, and the real cost isn't just in vacancy, it's all the funds you need to come up with to prepare the unit for the next tenant and get it rented. In other words, tenant turnover is silently killing your cash flow. Welcome to Strategy Saturday. I'm Charles Carillo, and today we're breaking down one of the most overlooked expenses in real estate, the true cost of tenant turnover, and what you can do to manage it. So let's get started by breaking down what we've realized about keeping tenants, reducing turnover costs, and improving your property's bottom line without spending more money. So in any business you're in, there are going to be some key performance indicators, some KPIs. They're going to be consistently tracked to see how you're doing. Like most rental investors, when I began, I was just trying to have the rent that tenants were paying me cover my expenses, and I was happy with that investment. So over the years, we've gotten a little bit more analytical, and we started to track some key metrics that we have recognized as having a significant effect on our net operating income. One of these is the turnover rate. However, before we delve into turnover rate, let's discuss vacancy. This is one thing that truly drives me crazy when speaking to investors or brokers who gloss over this metric. And when I look at a 10-unit C-class apartment property for sale, and the owner or broker puts in a 5% vacancy rate, because that's kind of like a standard in the pro forma. In other words, you're telling me that over a year with 120 months of possible rent collection, 10 units, by 12 months, you are going to collect 114 months or have only 6 months lost to vacancy. That couldn't be further from the truth. Even if rents are dramatically under market, and even when we purchase 100 plus unit buildings with on-site management and leasing, we don't pencil a 5% vacancy rate until the property is fully stabilized. And sometimes that is 6% or 7% if we start tightening our tenant screening. With that being said, reducing vacancy is crucial for increasing revenue. Now, to calculate the turnover rate, you take the entire year's number of average occupied units, divide that by the number of move-outs, and then multiply by 100. So what that means is that you have 100 average occupied units, and then you say you had 50 move-outs, and now you have a 50% turnover rate. Now, I've seen some people calculate it by the total units, not the average occupied units, but that shows a more collective vacancy and turnover rate, which rather than an actual turnover rate, where we want really an actual turnover rate. There's not a problem having vacancy in a property. Vacancy is one thing, you're not getting rent off that, but turnover is really costing you money. And the industry average turnover rate is around 40 to 50%. So anything under 40% is considered great. And I would try to improve annually rather than focusing on some generic industry statistic, because every market is so different. It's one of those things where you just want to improve next year. And if you're improved since last year, you're doing well. Currently, the cost of turnover of an average B-class property is just over $5,000. I think for us, it's like $5,200, $5,300. And that includes rent loss, a vacancy, unpaid balances, and turn and make ready expenses. Okay, there's a lot of parts to a turnover. And if you're doing a more in-depth renovation, you can add those additional expenses on top of the $5,000. Still, hopefully, in that scenario, the rent premium will be higher to justify the extra cost. So for example, you have the $5,000 I just told, you have another $5,000 you're putting in for renovations, but hopefully you're doing this because you're gonna get an extra $200 or $300 a month in rent, so that's gonna justify the extra cost. So how do property managers reduce tenant turnover? Number one, negotiate rent renewal increases with residents. Number two, keep open lines of communication with residents who give notice to understand their issues and address their concerns. And this includes addressing solvable issues to encourage these tenants to stay, and contact the tenant within hours if they give notice to move out, not days or weeks. There's several times that I've rented from professional managers, and it's one of those things where you give your notice and you don't hear from anybody. They don't want to keep you, they don't care about it. It's just business as normal. And that couldn't be worse property management. It's one of those things where you have to speak to the tenant and you have to find out why they're moving, and you have to try to see if they'll stay. Sometimes they're moving for work, whatever, they can't stay, understood that. But for other times, this isn't working, this is a problem. And then when you figure out how much that's going to cost to fix it, it becomes easier to fix it and try to get them to stay before they're already moving out. And negotiating rent renewal increases with residents, going back to step one, that's going to be one of those things is when you tell them this is where the rent's going if you stay, and have your number in there and have how they can contact you, that's going to be one of those things where they're going to be able to go back to you and go, can't pay this, but I can pay this. And then the negotiating starts there. But you also get to keep them. You're going to get more money for next rent, even if it's not at market rent. Number 3 is considering offering concessions to retain tenants, possibly unit updates. Now, for example, a tenant has an older refrigerator that has required multiple visits, or like an ice maker that hasn't worked from your handyman. Maybe give them a new fridge if they sign for another year. That's going to be a fraction of what it's going to cost to turn over. This person already has good credit with you, in other words, because they've already paid rent for a year or so. You know they don't make any trouble. They're still there. They're still tenants of yours. So just giving them several $100s of something, but also it's also adding the value to your property. When you have a new fridge in there, now that's for you. You know, I'm not going to have any issues with that appliance for 10 years. I don't have to have any more calls there. I don't have to waste sending my handyman there and paying him $40 an hour. So there's all this underlying benefits that maybe a landlord doesn't see that comes along with updating their units. And also, we're going to keep them from leaving. Number 4 is reach out to tenants months before a lease ends to get them to renew, before they even have a chance to shop around. You want to be there before they start looking on Realtor or Zillow or something like that to start renting. Even if you get them to stay with a $500 appliance, a $1,000 appliance, it's a fraction, like we said, of what it will cost you if they move out. And I also prefer raising rent, even if it's 1% or 2%. So I'd rather raise the rent and offer an update than have no increase in all, and you're just like, give them appliance. This way, it sets with them that my rent's going to go up every year here, but they're going to work with me and fixing and updating the unit as it happens. Managing vacancy and tenant turnover is something that every landlord can do, no matter the size of their portfolio or their financial resources. Minimizing both is key to increasing your property's net operating income, and is especially important if you plan on selling or refinancing your property in the next 2 to 3 years, because keeping people in your units is going to keep your NOI high, which is going to get your value high, which is going to make it easier for both those events to happen. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. If you always want to invest in real estate, but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
This episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.